Hey there, Ken French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Ken French, Vast Voice, telling business secrets to entrepreneurs. Really glad that you stopped by.
Estate planning, I know you don't want to think about it, but if you want to make a nice orderly transition of assets and lower your taxes for your heirs, I know then you care about this. Hey there, Ken French with VastSolutionsGroup.com. We've just recently merged, if you will, with a company called Asset Defense Team to form VastAssetDefense.com. Ken French with VastSolutionsGroup.com. This strategic alliance has made a huge difference for our business owner clients. Why? Because now one-stop shopping can be had here. We at VastSolutionsGroup.com do tax, finance, and artificial intelligence to help small business owners. Over there at Asset Defense Team, what they do, Bob Bluhm specifically, who's the guru of attorneys as far as asset protection and estate planning do. What they do is, well, asset protection, estate planning all over the country, just like we do. It was a perfect strategic alliance. Hence the reason VastAssetDefense.com was born. Let's get right to this presentation. This is a presentation that's going to help you to really better understand estate planning, why you should be doing it, what are the specifics of estate planning. A lot of people keep putting it off. They know they should do it. It potentially could lower tax liability to the heirs. If you don't want your debts out there, as far as, if there are any issues when you die, well, this is a nice orderly transition for your assets. So let's get right to it. I'm going to share my screen, which I always seem to do, and then we're going to get right to the presentation. By the way, thank you so much for taking part in this. We're going to have a presentation at the end. I should say a little bonus at the end, which I think you'll be happy about. So let's get right to it again. Do estate planning before it's too late. That's the reason. Why have I called it that? Because I know what it's like. People put off estate planning. They keep putting it off. I can tell you so many situations where our clients didn't do their estate plan, and then at the end, when there was an issue, man, was there an issue for the heirs. And I know me personally, I don't want to leave a big mess to my heirs, to my kids, to my wife potentially. Well, this is one way of making a nice orderly transition of your assets, etc. If you're doing the estate plan before something actually goes wrong. Here, what is an estate plan? Let's define it specifically. Your estate plan describes your wishes for how your property, meaning assets really, should be distributed after your death. And by the way, as I mentioned, maybe even in a tax intelligent manner. Who am I? Ken French with VastSolutionsGroup.com, author, 3 books. I've done, I'm a former Forbes.com small business contributor. I've been around for a while, as I said, down there at the bottom. I'm old. I've been in business since '94. I run VastSolutionsGroup.com, which is, again, a VastAssetDefense.com company. And I've been speaking all over the world about asset protection, about estate planning, about taxes and mitigating taxes and artificial intelligence, which we've been doing since 2018. We started in 2010. We had our first model, our first chatbot, if you will, in 2018, before it became kind of the cool thing. So let's talk about the 5 goals of estate plan. Here, eliminating the inevitable confusion, which I've talked about. A will usually doesn't go far enough. Number 2, choosing the legal guardian who will raise your children potentially. Makes it really nice if you have kids and there's some issues. Well, it outlines who will be really in charge of your kids, who will help you with your legacy. Ensuring that your assets will be distributed to your loved ones versus, there being a fight at the end of the day. And also minimize taxes. That's a big component. What we do here at VastSolutionsGroup.com help minimize taxes legally, ethically, and morally, usually using artificial intelligence to do so. Although there's less so in estate planning. But anyway, and by having an estate plan in place, you could potentially lower tax liability. And then finally, create peace of mind. I say leaving a legacy, to your loved ones. Estate planning terms, things you need to know when we're going down this path of estate planning. Again, all the property or assets you own at the time of your death, including stocks, bonds, mutual funds. If you owe money on your house, as an example, that would be a debt. Property, real property, which here includes, land and the structures, as well as all those assets associated with them. Personal property, like household items, bank accounts, the stuff that sits within the quote property, if you will. Beneficiary who will take over the assets, who inherits the money. Grantor, the person who's transferring the property to the beneficiaries, which likely would be you. We're going to go over that just a little bit. Trustee, the party that handles the true admin. Think of it as the paperwork, executing the will and distributing the property. Sometimes they're called the fiduciary. You've heard of the term fiduciary responsibility. That's the person who's entrusted to take care of, in this case, the trust. Probate, that's a scary term. Should be a scary term to you hereafter. It's a legal process followed by the court system. Your state determines your heirs and distribute the property to them. You do not want to go through probate, generally speaking. Okay, let's go into, understanding wills. Wills are, I'm not going to say a bad word, but they're just not as nice as a total estate plan. You must, you've always heard, you must be of sound mind and body. In most cases, you have to be 18. You have to fully understand the nature and extent of the property that you do possess, which probably you do if you're watching and listening to this. If you're watching and listening to this, you're probably a big time, probably a real estate investor, maybe a big time real estate agent, and you're of sound mind and body, meaning you know exactly what's going on. You've been in the industry for years. You're kind of one of the high hitters, big hitters. By the way, the will has to be signed, dated, and it's got to be witnessed generally. Many states require that it needs to be notarized. That really is what constitutes a will. So what are some other terms? Testator. It's the person who's died, but you have a will. And the executor is the person who's really taking over as it relates to the will, meaning the execution of the will. And the guardian is the person named in the will or appointed to take care of the kids, or maybe even someone in a special needs situation. Now, the three things that a will cannot do: you can't disinherit your spouse. That's a big thing, especially nowadays. You can't leave an excessive amount to charity. It's not legal. And then it does not avoid probate. Remember how I said that was a bad word, probate? You cannot avoid probate. You're still opening yourself up to the public. That's really what probate is. It's just basically crying to the public what's in your estate. It's possible to prepare a will without an attorney. Usually not advisable. Let's talk about that, because sometimes people say, "Oh, I'm just going to go to the internet. I'm going to use a artificial intelligence LLM model." Well, the issue there is in some cases they're wrong. Sometimes you don't get specific specialized. That's a concern. If it's not specialized, if something's not specialized, it could be challenged in court. You could spend a little bit extra. I don't know what the amount is. Let's just say it's 40%. I don't know. Let's say it's 40%, but in that case, it's 40% of insurance. There's an insurance cost because you're spending more money to make sure it's taken care of if you were to die, or when you were to die, if you really think about it. But if you pay that extra, let's say 40%, someone's looking at the overall situation. Maybe, who knows, maybe they're using Chat GPT. I don't know. But at the same time, at least they have a legal expertise to help work with the artificial intelligence model. Now, that's coming from us. We believe in artificial intelligence models. We believe in working on the internet, low cost. But at the same time, some people want it taken care of. They want the process to be walked through. They want someone to specialize the whole process for them, as far as taxes, as far as qualified plans, as far as investment in commercial property, real estate, as an example. That's what we do, right? But at the same time, sometimes people say, I want to do it myself. Okay, you want to do it yourself. You don't have that extra, whatever it is, 40% fee, like I was talking about. Let's say it's 40% more. Well, okay, then don't pay for it. If there's no value given, don't worry about it. But generally speaking, we believe there's value in working with an estate planning attorney. Okay, let's talk about trusts, because that's the biggest component of an estate plan. Really, it's an agreement that dictates how the property will be held and managed to the benefit of another individual. In this case, you. Let's say you were to die, as far as the estate plan goes. So what are the four common trust classifications? One can be revocable. Remember, I said revocable. It can be changed by the grantor during their lifetime. What's irrevocable? It cannot be changed by the grantor once it's established. So meaning it cannot be changed by the grantor once the trust is established. Now, a living trust, it's a property that's transferred, to a trustee while the grantor is living. So the trustee is taking care of the trust while the person's living by the trustee. It can be taken back by the grantor. So that's the reason it's a living trust. We could say, I'm going to change it. I'm going to make it so I could change it. Okay. And then a testamentary trust is created by a will after the grantor dies. So it's within a trust, in effect. So let's talk about general patent. I like this. This is the reason I put this in here. A good plan, violently executed now, is better than a perfect plan next week or after, let's say in this case, after the death. Now, that goes back to the point, well, if you're not going to worry about the 40% or whatever the case is as far as the attorney fee, well, at least get something on paper. You got to get something on paper. Get an estate plan on paper. You're going to need an attorney anyway, by the way. But well, do it now versus waiting until it's too late in that example. What's a marital and non-marital trust? Let's go and talk about it in 3 different forms. A Q-tip, it provides for a surviving spouse during one's lifetime. And if you really think about it, the spouse gets to get money from the trust, but they have no control over the trust upon their death. Okay. Now, a general power of appointment trust, or GPA, here it says, to be very specific, it provides the most control to the surviving spouse, which makes it really nice. The surviving spouse gets to control what's going on going forward. And finally, the estate trust provides income to the surviving spouse on an ongoing basis. Okay, non-marital trusts, and this is important in a lot of cases here. Sometimes they're known as credit shelter trusts or bypass trusts. A non-marital trust can provide for your spouse and children, but they avoid estate taxes for your estate and that of your spouse as well. So remember that non-marital spouse trusts, sometimes they're called, gets around estate taxes, which is nice, right? And by the way, this is the type of trust that's usually revocable. Remember how we talked about revocable and irrevocable? And it names your spouse or your children as beneficiaries. Now, as long as the 3-year rule has been met, let's go to 3-year rule, my mistake. The trust must exist for at least 3 years before the grantor's death. So you can't do it at the last minute, right? Which makes sense, right? 3-year rules is sometimes what it's called. As long as the 3-year rule has been met, the assets of the trust are excluded from your gross estate. So think about that. So let's just say you've put in, I don't know, pretending you're $100 million into a trust. You last 3 years, you potentially get around estate plan taxes. Now think about that. That could be a huge, huge chunk of money that you're saving your loved ones. QDOT. I'm not going to get into QDOT right now, but how about this? Suffice it to say, if you have any issues and you do have a QDOT, talk to your advisor. Call us. We can get really specific with the QDOT specifics. Now, let's talk about irrevocable life insurance, or ILIT. A little bit less interesting than they used to be for a number of reasons, but they still, pretty soon they're going to be a bigger deal. Once they were really used for wealthy families, less so now. Funded with life insurance that avoids taxes for the estates of both spouses. And the trust basically owns and is the beneficiary of the policy. So there's not an individual, instead it's the trust. So the trust life insurance is in the trust, in effect. And the heirs, now think about this. The best way to say it is, your heirs are the beneficiary, but they don't own it. The trust does. So just think about that. The nice part is your heirs are the beneficiary of it, though, right? So that's why it gets around some estate taxes. Same thing with the 3-year rule, because remember how I said 3-year rule, you have to last 3 years or live for 3 years. Same thing with the life insurance that's in the trust. By the way, they can be set up and they're expensive, but they're usually irrevocable. I always forget that. Let's talk about charitable trusts. A lot of people are now talking about charitable trusts. Why? Because sometimes you could structure them in that, so you're giving the charity and you get income from the trust, which is really nice in some cases. Let's talk about a couple different trusts. Charitable remainder trusts. So it's a charitable remainder trust is a great planning tool for anyone who's had, let's just say you got Microsoft stock, you bought it for pretending $1 and now it's worth $100. But you don't want to sell it because you have a big taxable event. Well, if you put in charitable remainder trust, the trust allows you, if the asset, in this case Microsoft stock, is in the trust, when you sell it, you don't have to worry about personal gains, capital gains tax for you as an individual. it's an awesome way to get around taxes legally, by the way. And remember, you have to be charitably inclined to really take advantage of this, in my opinion. So, if it's taxes that's driving you, that might be an issue. But if you really want to take care of a charity and also getting the advantage of a tax element, charitable remainder trust kind of sometimes can make sense. But now you've done the action, or in this case, the execution of the sale of the stock, Microsoft stock in my example, and then you get income from it. Charitable remain trust. It's a beautiful way, really, of one, taking care of charities, but also providing income to those who've got a highly appreciated asset and they want to take income on an ongoing basis. Let's talk about charitable lead trust. It's a trust that serves, it lowers the taxable liability for the individual. So the trust, it donates a portion of the income from the trust and then transfer the remaining portion of the trust to the beneficiaries after a certain period of time. So it allows beneficiaries to pay less in gift taxes, which is a huge issue. And a lot of groups will help you to set these up because they want think about it, because you get a deduction, by the way, but they want the asset. So the charity ends up with the asset, so it works out for both parties. Now let's talk about the taxes in the estate, which we work on a lot here at vastsolutionsgroup.com. A couple things you need to know. Estate taxes are referred to sometimes as the death tax. Sometimes if you're in a state where there's a bad death tax, well, you probably know about it, right? It takes property that's transferred or received at the death of the owner of that property, said property. Inheritance tax is at the state level, and it's not in all states. Talk to your advisor, because sometimes, some way, it would be advisable for you to move if there's an issue. As I mentioned, but the estate tax not is at the federal level, and the estate itself, by the way, it's not technically a tax, although it is, but that you're receiving property from the state. Inheritance tax is imposed on the person or the party receiving the property. Now, a little bit more about estate taxes. How are they calculated? Us as a tax advisor, this is pretty important. Estate taxes are taxed on their net value. And what's that? To find the net value, you start with the gross value. Let's say we're talking $1 million. The gross value includes all the state's asset, every little house, car, et cetera, includes all the probate, right? Now, at the same time, then what you have to think about, well, number two, these items are then subtracted. These are the things that are subtracted from what I just mentioned. What I say, $1 million, right? Funeral expenses, claims, or debts that are owed from the estate to debtors, like your mortgage, as an example. Now, also expenses related to the administration of the state. So really, anything that's an expense is subtracted from the gross amount. So let's just say, in my example, you have $1 million. Then I mentioned the state, and then you have whatever, $500,000 in liabilities. The net of that estate is $500,000. Now, what's the role of life insurance in estate planning? Because there is some. Life insurance has a place in most estate plans, which a lot of people forget about, but it really does, because for whatever reason, the laws that we now have in place are really favorable as far as sometimes at least putting life insurance in an estate plan. Now, if you have a modest estate, it probably wouldn't help to have life insurance in an estate to reduce taxes. That wouldn't be appropriate, unless, of course, you want to just take care of your heirs. That's different, right? And for most of us, but meaning for taxes, it doesn't help you reduce taxes. An insurance policy is strictly a source of funds for our beneficiaries, which I'm basically stating there. But generally, funds received from insurance policies are not taxed, which makes it really, really nice. Let's go into the two types of life insurance used in plans. There's survivorship life insurance, and those are sometimes they're called second to die policies, harder to get nowadays than they used to be. They insure two or more people, so a spouse and a spouse, but only pays when the last person dies. So spouse A dies, then spouse B, as an example, that's when the life insurance proceeds are paid out. The premium is lower on those policies, by the way, because there's two lives. Now, then there's the first to die life insurance policy. So it covers two or more people, but pays when the first person dies. So let's say you have a couple, and let's say the man dies first. That's when the life insurance is paid out, not on the both lives. A little bit more expensive premium. So choosing beneficiary for life insurance policies, it's tricky. It's something you really have to think through as an example. Why? Because it's, usually a little less expensive than trust because you're, naming just one individual. But still, it gets quirky, and let's go over it. So you have lack of control, how the insurance money is spent. So that's an issue. And in a trust, you could dictate how the money is paid. Also, let's say there's a minor child, you're going to have issues because the money could go into the minor child's bank account in effect, and who knows, maybe a unsavory individual could help manage that money, and who knows, maybe even point it in their direction. Now, let's talk about health insurance and kind of other concerns really quickly. Who makes the decisions when an individual can't? You can include that, meaning within the plan, in the estate plan. You can include that within the plan. Also, you can plan your own funeral when you're living. So whatever your wishes are at that point, you could do it. A living will also, by the way, describes the wishes regarding life support. That can be an issue. Some people have very specific wants, desires as that relates. Just in sum, estate planning is really important. Set up a plan. You got to do it now versus later. Again, I get it. Nobody wants to do it. Everyone wants to put it off. But it's in your benefit to do it now while you're thinking about it, or you're of sound mind. Because for me, I know me, when I'm on a plane, I know this is going to sound crazy. When I'm on a plane, I know that my beneficiaries, for me and my wife and my son, are taken care of if something should happen. Hopefully when it's rocky and rolling, nothing's going to happen. But man, I know it's crazy, but I think, my family's taken care of if something should happen to me. I don't want anything to happen to me, obviously. Hopefully they don't want anything to happen to me, but they're taken care of if something should happen. Now, I like that. I believe it or not, I rest a little bit easier because I know that that is the case. They'll be taken care of if something should happen to me. Now, in closing, speak to a qualified person. I keep saying this, but it's true. Go talk to your advisor. If you don't have an advisor who knows about estate planning, asset protection, et cetera, come to us. Bob Bluhm has been doing this for years. He really is the father, what I call the godfather of asset protection estate planning in the U.S. He knows asset protection estate planning better than, I would say, anyone. If you have any questions, please go to your advisor, then reach out to us at vastsolutionsgroup.com. Once again, my name is Kenner French. It has totally been a pleasure.